much conviction do you have to keep deploying money into this market?
Well, obviously we focus on the enterprise software space, and we think the value of the companies that we buy really exists in any market. I think we look at what market we're in and where we see the best opportunities. So in 20 and 21, when public markets were incredibly expensive, we really pivoted to largely buying private deals, private companies, oftentimes founder-backed companies, and really convincing them to partner with us on the next phase of their journey rather than going public. This is a completely different market. The real opportunities right now, we believe, are in the public markets. So, just this year we've announced the acquisitions of Avalara, Duck Creek, and KnowBe4, which are all public companies that were trading at significantly higher valuations 2 years ago. Great companies, phenomenal products, very defensive products with the potential of a recession, and we just think that's where the value is right now, so that's where we've been focused.
Definitely want to get back to the future dollars you're looking to spend. However, you mentioned the R word, recession. That is clearly the undertone, and a very wide variety of views out here. What is your view on the outcomes, the range of outcomes, and the worst case scenarios?
Well, we talked about that at a panel, I think, almost eight or 9 months ago, when I think the world looked, frankly, in some respects, a little bit more uncertain than it does today. Obviously, the Fed's going to have a major influence on, where we end up, but I think our view is that, more likely to be a soft landing or a mild recession as opposed to a deep recession. Again, we're certainly underwriting to a very conservative case because we're very disciplined and prudent in our underwriting. Our companies are actually, many of them are seeing growth right now. If you look at the estimates, IT spending is actually going up in 23, and software in particular is seeing the benefit of that. So we're actually seeing very good underlying performance in our portfolio. We're certainly being cautious about what the future market looks like and how we want to pursue opportunities.
Today aside, there's certainly pressure in the market today, but in general, things have held up okay, even without all of those recession fears on the horizon, with all those recession fears. So are valuations in certain places still looking a little frothy to you?
Well, what's interesting, there's really been a bifurcation between public and private right now. So private sellers, private companies got significant capital infusions in 20 and 21. The growth equity market deployed the most capital that they've ever deployed into these, late stage growth companies. So they entered 23 with, a fairly good balance sheet, the ability to continue to operate. We believe that later this year, they're going to start to feel pressure, and they're going to have to accept the market that they're in. So, right now, private companies are hesitant to transact. Those that did, prior fundraisers at very significant valuations don't want to take the reset.
Let me get this clear. As a private equity executive, you're telling me that private market valuations have a ways to drop.
They do. They do.
What does this mean also? You've been doing a lot of take privates. You're investing in the public markets. How many more of those deals do you see done this year?
It's hard to predict M&A. I would say that we're tracking a number of companies that are companies we've known for many years. We think they're fantastic companies. We think we can bring value to them as a private enterprise. And the real question is, which companies can we get to engage in a transaction? I would like to see us do 2 or 3 more transactions this year.
How about the financing markets? Are you seeing them starting to open up again for you, or is this still a lot of fear and backlog in terms of the banks?
What's interesting, there's been a real growth in the, kind of the private credit market that has really filled the gap as the big banks and the broadly syndicated market has really been frozen for the last 6 months.
Do you prefer it?
I wouldn't say we prefer it. It's just the quantum of leverage that you can get from the private markets is maybe $4 or $5 billion at the upper end. So it really kind of defines the parameter of what businesses you can look at. We historically have not relied on significant leverage to drive our returns. So our average, in our large cap fund, our leverage levels are sub 20% loan to value. So, we're not really constrained. Obviously, leverage is more expensive, debt is more expensive right now, that doesn't really constrain us because we're not relying so much on debt to drive our returns.